Good morning, and I always enjoy this part of the program where people have an opportunity to beat me up and tell me what I got wrong. For people who actually do this for a living instead of just look at it for a living. We have a great panel today, and we have a wide variety of perspectives, so that was by design. We have Scott Felix, who is the Executive Vice President of Hutton Development, and he is going to come to us from the perspective of someone who actually develops multifamily properties here in Southern California. We have Tracey Burns, Vice President of Construction Lending for Century Housing. She brings two perspectives to this. One, the perspective of a lender, and how are you thinking about construction lending in a time like this, and what do you expect to see supply? But also, she's a lender for affordable housing, so she can, or workforce housing, right. And so she can give us this perspective as how do we meet the needs of people whose needs are being unmet at the moment. And finally, superstar multifamily broker, Kitty Wallace from Colliers International. And Kitty has, I think, the broadest bird's eye view of the market because she has to deal with everything everywhere and can tell us what she sees. So first of all, thanks to all three of you for joining us. And we're gonna start with the guy who builds stuff. Scott, tell us what you're thinking at the moment.
Hello, my name's Scott Felix. I'm with Hutton Companies. We develop apartment communities in Southern California, have communities in Los Angeles, Orange, Riverside, San Bernardino counties. It's a tough business, and it's. I think it's always been tough, but it feels like it's getting tougher. I think many of you folks know that there are a lot of banks that are household names that are not lending, or those who are lending are having very, very large equity requirements. 55%. Or so loan to value. A lot of the home builders are not building and have closed their pipeline. So it's very difficult to make construction budgets work today, and it's very difficult to obtain financing.
So in terms of raising equity too, has that changed? Are hurdles changing when you're going out and looking for partners, or are they staying pretty stable?
I think that's changing, and I think they're being more and more cautious.
And so what about, in exchange, are splits changing if the hurdles are rising, or is it just, I guess what I'm asking is equity getting a lot more expensive as well as debt?
Yes.
Okay. That was pretty, okay. Tracey, okay, you're a lender, so tell us how you're seeing things at the moment.
Yeah, so we're in a small space, so we finance projects for small urban infill developers. Most of their projects are in San Fernando Valley. We have projects in Koreatown, and we have projects in South Los Angeles. And so what we're seeing, in 2021, we closed about $80 million in construction loans. And so once we closed these loans in 2021, we started to see that construction costs started to rise. And so, we started to see that our borrowers' budgets were kind of disconnected from what we first saw. And so we saw costs going up between 10% and well to the tune of 30% increases. And so what we had to do was we really had to take a step back and just kind of look at their budgets and see where they were as far as cost percentage complete. And, we actually got very, very lucky we have some really strong borrowers, great balance sheets, they have great liquidity. And so outside of the contingency expense, they were able to just write a check for the balance. We saw a huge increase in lumber. We saw a huge increase in drywall. So, but again, we got very lucky. Our borrowers were able to come in and pay those costs. We didn't have to do any construction loan increases. So we got very, very lucky. Going into 2023, we are definitely looking at a different underwriting. We are we have to be more conservative. We have to add more cushions on our interest rates. We have to add more cushions on our interest reserve. We're even looking at our operating expenses, and we're looking at them in the tune of, we're seeing costs going up with insurance. We see costs going up with services and goods. So we have to also take that into account so that when, our borrowers go for their perm loan conversion, that we have adequately underwritten their operating expenses. And, we're looking at we have a healthy pipeline for 2023. And, the deals that we're underwriting, a lot of them are just not penciling out right now in this interest rate era. A lot of these deals, the borrowers are going to have to come in with more equity on the front end. They're going to have to, pay construction costs up front. And then the deals that are just not working, we're seeing that borrowers are just really holding off until they see some relief with interest rates. And it seems like they're holding off until the second quarter of 2023. So that's kind of where we are. That's what we're seeing now. Obviously, we're seeing rents, have increased in the double digits over the last 2 years. And we see rents are slightly increasing maybe for the first quarter of 2023. So that's also something that we're looking at. So we're really trying to work with our borrowers. We're trying to get these deals to pencil out. But again, it's pretty tough in this where we are.
So your current construction loans, I mean, I assume takeouts are arranged for them, but are the takeout lenders changing their terms, and what's the implications of that?
Well, it seems like the takeout lenders are changing their terms, and what we're trying to do is if we can get our borrowers to get an LOI, it's not set in stone, but if they can get an LOI just to show us what their perm lender is lending at that time, we can look at that LOI and then kind of underwrite our deal accordingly. So we kind of want to see what perm lenders are using as far as operating expenses, as far as what interest rates they're going to be looking at. So we try to, if we can get an LOI, we try to underwrite to that LOI.
Yeah, go ahead, Katie.
What kind of interest rates are those, and what exit cap are those?
Well, we're looking at a 4.5, maybe a 4.5 exit cap on our loans, and we're looking at an interest rate right now of about 6.5%.
So, but what I was also asking is, you must have you must have projects in the pipeline that haven't gotten their perm loan yet. They haven't taken you out.
Right.
So what's going on? What's that negotiation?
Well,
like?
I mean, yeah, we have $80 million worth of loans in the pipeline. Then we have loans that we created this year. So, again, when we look at underwriting on the back end, we underwrite our borrowers, and we work with some really good borrowers. They have really good balance sheets. They have, they can pay down these loans if a perm lender comes in and says, you have to pay it down. So again, we have some strong borrowers.
So Kitty, tell us your view of the world right now.
I'd love to have one more question for Tracey.
Yeah, go ahead, please.
What percent of your borrowers do you think are on a pay down to get to refi out at this point? I'm gathering you're doing 2-3 year construction loans, and maybe you're doing 1 to 2 years extensions for these people?
Well, we're doing 24-month construction loans, but these right now today, these construction loans are turning into, 30-month construction loans. They're turning into 3-year, construction loans. So, we're just kind of looking at, where we're underwriting today as opposed to what we're going to be seeing in the future. And I can say this, that out of all the loans we close, we've never had a borrower that had to pay down their loan. They've never had to pay down their perm.
Perfect.
Yeah.
All right. Well, that's good news.
So I'm hoping that doesn't happen this time, but we'll see.
And I think that's part of the thing is we have this wall of capital that's out there, and that wall of capital has been there forever, and it's still there. So
Yeah.
my name is Kitty Wallace. I work for Colliers International. I run a team of 9. We sell all things multifamily here in Southern California. Thank you for having me, Richard and SC. And
Yes.
fun to be here, and especially fun to always listen to Richard. I always bring a notepad and take down some notes and have some words of wisdom that I listen to every time I talk to Richard. I work 80 hours a week talking to clients all day long doing deals, and I can come here in 30 minutes and Richard tells me what I had to spend 80 hours a week for years to opine and get the same information. So I think we're pretty much in tune with a lot of them. I think I'm a little ahead of the curve on some of these things that you haven't seen quite yet. So hopefully
tell us about that, yes.
Well, like one of the things you're talking about, the net migration in Los Angeles and New York, right? We saw during COVID, I saw exactly what you put out there, right? We had people leaving the state of California. We had people leaving Los Angeles going to Orange County and San Diego because Orange County and San Diego were a little more unmasked.
Right.
You could go to entertainment, you could go to restaurants, the schools were open. We did more business in Orange County in the second year of COVID than I did in LA County, which is rare, right? And they were out in
Because
the Inland Empire.
Orange County is about a third the population of LA County.
Yeah,
So,
but not only were the tenants and the residents, and they could afford to pay the rent in Los Angeles, and they had their job, but they didn't have to be in the office. So then they're like, well, I'll just go to Orange County where it's open, or I'm going to go to Denver, or I'm going to go to Arizona or Texas or Hawaii. So we had a lot of that out migration at that point. You know, if you look right now in Los Angeles and New York, the finance district in New York is a place people want to be in, downtown New York. So those rents have outpaced everything we're doing in Los Angeles, and same with LA. People want to be here when everything's back, what you're talking about. But we're seeing people come back already that had left. I think over the last 15 years, our yields are tighter, right? Our cap rates were always a little lower in Southern California. So maybe people left 15 years ago to go to Nashville, Arizona, Texas, Vegas of the world. We've seen a collection of them come back because they're saying, if I can build for $250 a unit in Texas and they're offering me $350 a unit, and I'm paying the 3.5 cap there and it's a 3.5 cap in LA or a 4 cap, I'm coming back to LA because Southern California has more projected growth down the road than we maybe have some of these areas. So what you're potentially projecting, and there's a little out migration in Los Angeles, I think those people are all coming back. Our rent growth in New York and LA are far outpacing kind of in some of these other pockets, because that's, I think, where people want to be for job reasons and fun and entertainment reasons. And I also think even look at like a pension fund advisors, the world is crazy, as you mentioned, right? Europe, Russia, Ukraine, this capital is sitting out here and they want to go to a place of safety. And when you look at safety, you look at the United States. You want to look at the United States, you look at California, New York, and then you look at life sciences, which is San Diego, and you look at multifamily, and we kind of end up being a place where if you're a pension fund advisor, you have to put your money someplace.
Yeah.
We're that place. So I think there's a lot of things to talk about. I mean, we had an election Tuesday that we can't figure out yet, and LA has some challenges. I mean, the ULA thing is a problem. I mean, as you're talking about it, we don't have enough development anywhere. I mean, the Inland Empire has school fees that are ridiculous when you're building in some of these pockets. We're not building enough units, right? In Los Angeles, we just added a 5.5% tax to people. So if you're a builder, do you want to come, even though you see this rent growth, you see this population growth, and all the reasons to be in LA, but now you have a 5.5% tax after you build that. Are you going to build there? Are you going to go to Burbank and Glendale? Are you going to go to Santa Monica, Beverly Hills? You're going to go to the Inland Empire in San Diego. It's like, is there another place? So we're going to continue to make our housing much more expensive because of our legislation. And that's what we've seen. We're seeing a lot of people come back into LA, but some of the institutions are on the sidelines primarily because of our legislation that we have. We've beat rent control twice, but that's an uncertainty that causes havoc in the world.
Yeah, I remember a few years back when LA passed a linkage fee. And I remember, it was kind of sweet. The people from the housing group of the mayor's office wanted me to endorse it, and I wasn't going to do that. And I was actually writing against it, and they had me up to City Hall to talk me out of my view on a linkage fee. And my view of linkage fees, it's like, okay, people are starving to death, so you tax farmers to grow things. Right? Yeah. And so there is this view that, and we could get into how do you help people afford housing, and I'm a big fan of demand-side subsidies instead of supply-side subsidies. But when you tax the thing that you're trying to develop that you need more of, that's not very helpful.
And I think people are trying to do the right thing. Their concept is, let's add this. But R.E. Cahan at Landmark, he has this great quote. He says, they giveth and they taketh away. So every time they come up with something that maybe they think is going to add more housing, they add something that causes more grief. And you've been great to have these. You helped, in my opinion, just your research, which was fact-based research of why rent control doesn't work. And I think that's part of the reason why it didn't pass when they put it on the ballot a couple different times. I don't know how we didn't fight harder to get ULA off there. We should have probably had you write some commentary on that for us. And we maybe have a couple days the votes come in, but.
So I do want to know, you're talking about, the interesting thing about migration is, again, you look at this Postal Service data, and I looked at this like 10 times to make sure it was right. But Travis County, Texas, which is where Austin is, now has out-migration. And Ada County, Idaho, which is where Boise is, has out-migration. And it's like they have gotten so expensive that the thing that they really had over Southern California, which is cheap housing and jobs, is now I mean, they still have jobs, but, and so it's, you do wonder how much that's going to tilt the world. What's difficult, the thing I would love to be able to forecast is migration. But when we do migration modeling, where we look at things like differences in house prices and differences in wages and weather and a whole host of things, well, they in a sense work in that you find the correlations between all these things in moving. What you, those relationships are very unstable. So like a difference in jobs might make a 10% difference in 1 year, and they'll make a 2% difference in the next year. And that's why it's so difficult to forecast this. And clearly, this is the thing that really matters. But that said, given how little housing that we're building, it's like if we have in-migration, it will show up and we'll get higher rent growth.
Well, that's the other one that I think we can forecast a tad bit ahead of you, because you said it's kind of uncertain, right? It's always been the lower income people, because Southern California is expensive to build. Even in the Inland Empire, if you're living, we had tremendous job growth, but the disparity between the quantity of income that those residents live and the cost of the housing, there's a bifurcation, and we don't have enough housing built there. But typically it's been the lower income people leaving, as you had mentioned. But not even now. We're a lot of the more, even on my friend basis and some of my clients, not only they building out of state, but they're moving out of state. Right, so like this is a personal thing, but I'll send out my holiday party list. Like we didn't have the holiday party for COVID. The year after we sent it out, like 10 of my friends were out of state. And these are people these are high paying income people who just left to go to other neighborhoods. So I think when we see the statistics, maybe it's some of the lower income, but I think some of those people come back. I think that there's reasons, and we're finding a lot of, especially the $300,000 kids who are going to the Boise, Idaho, or Texas, and those kinds of, they want to get back in the office and hang out with the people and be in these cities if we can control the homelessness and the crime and these things, which is where I think if you look at all the major cities in the United States, San Francisco is a top 10 city in the world. They've still got some structural problems that they can't solve. Outside of San Francisco, I think Seattle's got some challenges, Chicago has some challenges, but I think the rent growth on those pockets, we've had 20-30% rent increases in the Arizonas, Vegas, Texas of the world. We've had rent control in New York and Los Angeles. Our rents have been flat. For 3 years in LA in some of our buildings, we haven't been able to raise rents. So our upside is much higher. And the people are coming back. So I think we've got a better projection of growth, which is why I think capital continues to roll our direction.
And if you look at Dr. Green's slides very closely, particularly the new supply, you have 2,500 or so per quarter in Los Angeles County for the entire county. I mean, really think about what a small number that is for a county the size of Los Angeles. In the Inland Empire, 250 or so units per quarter. That's one job that if you know the market, you might be able to point to it and know the intersection where that job is. So I don't think those points can be stressed strong enough, how difficult it is to get new quality communities off the ground for some of the reasons that were mentioned before, construction cost, equity cost, cost of debt, and plus the timing. I mean, we delivered a community in Orange County late 2011. That job started with "Hi, nice to meet you" in 2016. It was a long road.
You said you finished in 2011 and it started in 2021.
I misspoke. 2021.
Okay,
I don't know what I said.
If you can do negative.
No, I can't. I don't know how to do that. I don't know how to do that. We opened in late 2021. Excuse me.
So how long have you guys been doing the Inland Empire?
Our first apartment community in the Inland Empire was in the very late 90s.
Okay. So can you walk us a little bit through how, because it used to be, there was loads of new construction out there. So what has changed over time that you've gotten this? It was sort of the relief valve for Southern California. Lots of houses got built out there in a fairly short period of time. And that's just stopped. So what are the mechanisms that led to that?
The fees.
Was mostly the fees?
Well, not mostly. The municipal fees, I would say, are a major factor. I think the land prices went up. 20, 25 years ago, you're buying maybe some agriculture land, and a lot of that's gone. So the better parts of the Inland Empire, western Riverside County and western San Bernardino County, are established cities that have been there for decades. There's pockets of areas where there's land to grow, but it's not as plentiful as it used to be.
So, yeah, it is interesting. There are people who suggest that the solution to the problem is like to start building like crazy in Beaumont and let people commute. But the problem with that is it is so expensive to do that commute from so Riverside is a job center, and Beaumont is 25 miles away, so that's 50 miles round trip. Cost of a car is 60 cents a mile, so that's $30 a day just doing that. So that's not really an alternative. So what you're saying is sort of the western parts of the Inland Empire have gotten built out.
Yes.
And that's an important driver of what's diminished the ability to do new construction.
Yes, the city of Ontario was incorporated in the late 1800s, for example. I mean, it was an agriculture sort of epicenter, for lack of a better term, but there's a lot of old housing in places like Ontario, Corona.
So so I know people are going to be upset when I say, but what if you just tore down some of that? Because we're talking about 50s housing, right? We're not talking about like craftsman bungalows.
No, there's some old craftsman bungalows.
Okay.
But if you start,
but there's some 50s housing too, right?
But then you're dealing with an assemblage issue, and you know probably better than I do how difficult it is to assemble land and do that in an economical way.
So Tracey, tell us a bit, where are the stuff you lend on, where is it located and how does it come to be located there? And what are the characteristics, what sort of requirements are there in terms of affordability or making it amenable to workforce?
Well,
housing?
most of our projects, and I would say about 90% of our projects are located in the San Fernando Valley. We have, again, projects in Koreatown, we have some in South Los Angeles, but what makes us unique is that, we are a nonprofit, and so we have to keep our rents at or below 120% of the area median income. So that's how we classify our units.
And just to be clear, that's like $100,000 a year right now in income, right? 120?
Yeah.
More or less?
About more or less, yeah.
Yeah.
The deals that I underwrite, we want the rents to be at 120 or below, which our rents are usually between the 80 and 100% AMI range. So that's how we keep the units affordable for workforce housing. And just to kind of Scott in the Inland Empire, we just closed a deal in Palmdale, which was my first deal that I ever closed in Palmdale. And so it was an acquisition loan, and it's going to produce 220 units of workforce housing. So that was pretty interesting because, again, we've never closed a deal in Palmdale. And in this day and age, we were thinking, okay, who is our market for that area? Where are the people going to come from? And we, said, we were going to get all of our tenants from. They had, they're building aerospace, engineering, people of that walk of life, will be utilizing this space for these apartments. So But again, that was our first deal that we've financed in Palmdale.
So this was a market rate apartment that you've converted to affordable.
Well, it's going to be, it's actually an acquisition loan, so they're going to put 220 units of workforce housing there. So again, it has to be rents at 120% below. So we're looking at rents of, two bedroom of about $2,000 for those units.
So when you do stuff in the valley, this comes back to Scott's point about land assemblage. Are you needing to assemble land, or are you finding parcels out there that you can just do development?
Well, no, we're not. Well, we're finding parcels with dilapidated homes that they're buying, they're tearing down, and they're building these units. We've closed maybe 3 or 4 where there were automobile stations, so car repair lots that they're buying and rezoning and building housing. So there hasn't been a time where we just went out into the San Fernando Valley and found a empty lot somewhere. There was something that was on that lot in a single family home or some type of business.
And then you have to deal with that history.
Right.
So
we have
for
to-
that
yeah.
car
Yep.
facility, there were
Yeah.
presumably environmental issues.
So we do a phase 1, we do a phase 2. Some of them have to come in and bring in new dirt. So there are things that they have to do before, we'll get started.
Then if you have to have agencies like the water board,
Yeah.
that just adds a dimension and layers and probably
Time.
a
And it
year
just
or a year
adds
and a half
to the cost
process.
as well.
Absolutely.
That project,
And all that gets passed through.
So Scott talked about a deal that took him 5 years to do. How long typically does it take you? Does it take you? Well, you're on the lending side, but the people you're lending to, what is their process? How long does that usually
As
take?
far as getting going from entitlement to completion?
Yeah.
Well, it usually takes, so if we come in at the acquisition stage, we can do a 18-month loan term for acquisition, for the entitlement stage. We come in through acquisition, we can get them through entitlements in about 12 to 15 months, and then we convert over into a construction loan. So I'll say the entire time could be 3.5 to 4 years.
So I just talked to Frost Chaddock out there. They're here today at coffee. They just got entitled on their Silver Lake deal, 200 units. They bought it in 2006. They got
Wow.
entitlements this year.
Wow. In
From
Silver Lake?
2006.
In Silver
Welcome to
Lake?
Los Angeles. In Sequa and the neighbors.
Wow. Yeah.
And so this is how you end up building in like a Lancaster or a Beaumont.
Right.
And I remember the rents in Lancaster and Palmdale. I sold a $200 million portfolio there in like 2009-ish. And the rents were so high everywhere that people go. But then that's what happens is then when you run into a correction, so 2008-09, things corrected, then people didn't want to do that commute, and the cost of gas was too expensive, and then they moved back where it was lower and less expensive housing.
Well, and then another thing that like the projects that our developers build is type 5.
Yeah.
So we're looking at there may be subterranean parking. We have all great parking.
Just tell everybody what type 5 is.
Well, it's just regular, like, a stick build building. There's no requirement for height. Well, there is a requirement for height, but they're kind of staying under the radar where they can just go in, get the project entitled, get the permits and get the project done. So they just stick with very basic type 5 construction.
So, and I'm assuming that once your developers complete their buildings, they have no issue at all filling them up.
No, they actually don't. We have no issue filling up the buildings.
So that's got to be our biggest void in the 80 to 120.
Yeah.
Because there's monies for affordable housing, right? There's monies for homeless house. We have all the home for keys. I mean, Los Angeles is out buying stuff. And there's money for high-end housing because it costs so much and the time to get everything entitled.
Right.
The big void is you get out of college, you're making $80,000 a year or $60,000. Where do you live when rents are $4 a foot and higher everywhere? And so if you can help the kids who need a little help to get themselves a little further, and that's a lot of what you provide.
That's where you go in with, roommate situations. And then most of our developers utilize the density bonus.
Yeah.
And so, they have some affordable units at 30%, very low income. So,
So, Kitty, I want to ask you a money question, then we're going to do a lightning round, and then we're going to open it up for questions to the audience. But do you deal with foreign buyers very much coming into Los Angeles? And if so, what has happened to that over the last couple of years?
Yeah, so very interesting. So we've always done so, and there's kind of waves of time. So there were times when we had Canadian pension funds who wanted to be here. We had time that China was here or Japan was here. China has done a big pullback. We got a lot of requests of some money that needed to be repatronized back to China, more recently. But I would say, but Japan has taken force and is bringing more monies here in the United States. So it's kind of a moving collection, and I do believe that internationally, Southern California, actually just the United States in general is a pocket again right now that's attracting those funds.
So the reason is, of course, the dollar is very strong right now, which makes American real estate look very expensive.
Yep.
Now, part of it is the rents are going to look really good too for exactly the same reason. But there is this issue of, in fact, foreign investors thinking about selling their U.S. positions because they can just make money on the exchange rate. So like if you bought in yen 2 years ago, exchanged yen for dollar 2 years ago, even if you make no money on the real estate and you sell it now, you've made a 20 to 25% profit just on the currency because, you're buying your food and so on in Japan.
But that's assuming they need the money, right? So if they need the money. And China is calling some of that money back, but some people don't need it.
Well, that's political too. But
Some people don't need the money. I mean, one of the challenges we're having right now, and a lot of what we sell are core product, right? So 15 years, you've made no money on your money, right? If today, I'm selling this building, and I had a collection of buyers, and one of my best buyers pulled out. He says, well, my financial advisor just told me, he says, I can go get 4.5% in tax-free munis, which to him is 6+% on his money. He's like, do I need to buy real estate? I'm like, well, yes, you need to buy real estate because you've got depreciation and appreciation, and the rent growth is outpacing this. But there's a real alternative to making some money outside of real estate with your cash.
Okay, I'm going to ask the panel a series of questions, and then we're going to open it up. So quick.
Yeah.
Over the next 2 years, rents on average rise more or less than 3%?
Yes.
More.
I would say less.
Okay.
This is California, right?
This is Southern California, right?
I would say less.
Vacancy rates over the next 2 years rise or fall?
Flat.
Vacancies falling.
I would say fall.
2 years from now, new construction is up or down?
That's a hard one.
I would say up.
I would say up from today.
Yeah.
I'm gonna say it's flat. I think people are putting some stuff on. I think we're flat. But it should be up.
2 years from now, more people are coming into Southern California than are leaving Southern California, yes or no?
Yes.
Coming.
I would say going.
Okay. And then final one is, now I'm going to be really unfair. LA, Orange County, Ventura, San Diego, what am I missing? Oh, Inland Empire. What's the best place to invest right now?
Orange County.
I'm gonna give it 3. I have to give LA, San Diego, Orange County in those orders.
I would say LA.
Okay.
Yeah.
Okay, great, thanks. Let's open it up for questions. Yes, sir.
I got a question. Does the scarcity of water play any role in the forecast of Inland Empire or any of these Southern Californians? Like, do we see water being any kind of issue in 10 years from now, or cost of water being an issue?
Well, so it is clearly an issue in a lot of places already. I mean, strangely enough, and I didn't know this until recently, Salt Lake City water is becoming a big issue, and the Great Salt Lake is drying up, and if it drops below a certain level, there are toxins that are going to go into the air that are really problematic, and so they're trying to deal with it. I think we're going to figure water out, and I think, again, people are going to hate me for saying this, I think we're going to figure out desalinization sometime in the next 10 years because we have to. I think also things like we're going to grow less stuff in California because as I'm sure you know, the vast majority of, well, I shouldn't say vast, but the majority of water use in California is for agricultural use. But I think human beings actually are good at figuring stuff like that out. It's not like it's unknown as an issue, but maybe I'm being too optimistic here.
We have a water consultant that we've had for about 15 years or so. And the intensity on that piece of the entitlement process hasn't picked up all that much. And I see that person as a wise man who we call periodically when water issues pop up, but we do need his level of expertise to address those issues because they're very specialized.
Well, what I think is an interesting thing, we have Governor Newsom comes out and says, hey, everybody stop using water in California. We have a shortage. But all the apartment buildings are master metered for water, so the landlords pay. So your tenants and your residents can use all the water they want. So Santa Monica is actually only one of the municipalities that requires when you're building in Santa Monica have an individual meter for your water. I think a lot of developers have done RUBs and utility reimbursements, but yet these are some of the bifurcations and disconnects, and honestly, some of that water is not used in the house anyway, but
No, pricing really works, and tiered pricing really works. So the idea that the water that you actually need, you pay very little for. So, you can take a bath and make tea and brush your teeth. So the water that's necessary, so you're not hurting poor people by making necessary water expensive. But then once you get beyond that point, you start paying a lot. And then when you get beyond a certain other point, you really pay a lot. And if you look at California, it's actually our per capita water use has gone down quite a lot.
Yeah.
And I think pricing is a big reason for that. And I agree with you. It's places that aren't metered are a problem.
Yep.
And, if it's the way government could help is providing subsidies to make sure everybody is metered on their water.
Right.
Most new communities, I would say for the last decade or 15 years, new construction have sub-meters.
Yep.
And I think that was done primarily as an economic move on behalf of the builders and landlords to pass that cost onto the residents. I think it does have a water saving component to it.
But it actually surprised me when I was working in DC 6 years ago and I was living in an equity residential building. And by the way, I overall really liked the building, but I was surprised that they didn't have individual metering for heat and air conditioning. You basically paid a pro rata share of your energy costs. And that just seemed silly to me because, and I actually did a calculation of the cost of metering and I figured they would save money. If you gave people an incentive to turn their thermometer down when it was cold and up when it was warm, or whatever the right way to say it, but it was, so yeah, metering goes a long way. But I think it wouldn't, but I don't know that it would be enough. So Patrick has a question.
Kitty, deal volume this month versus last year, same month.
I think this quarter, our team's probably going to do 80% of the volume that we did. We closed like 4 deals this past month, relatively online with the year before. Arizona, last year, the state and the larger projects, our team told me they did 80 deals. This year they did 14. So this is where the money is moving back to California. People are unwilling to pay the same. The cap rate was the same 2 years ago. I've always sold deals with 30 buyers. The first year of COVID, we'd have a buyer, a great deal, and my neighbor's saying, well, I can't rent my unit. Why do I want to buy another one? Which had never happened to me in 23 years, right? Then kind of came to level. At this time, Arizona had 30 buyers for every deal, and their cap rate kept coming down, and they were getting 30% rent increases, but those rent increases now are flat. So my Arizona team's telling me, their occupancy's at 94%, so below the 5%, so rents are going down. They're saying top end rent is flat. They're closing loss to lease. We're getting lease trade outs of $750 and more in almost everything in Southern California. So the money's coming back this direction. So it comes back to, if you need a yield and you need to place your money someplace, you'll take maybe a little lower yield for a little more safety. And we look relatively safe. So I think we'll still do some business. And I've been doing it for a long time and I have a really great team. On it is here somewhere. meter if you haven't.
Over here was next, and then.
Hi, quick questions for Scott. You talked about how difficult it was to, for the construction budgets and financing, and you mentioned that equity rates are going up. What kind of equity rates, or at what levels do those equity rates have to be to bring partners to the table?
That's a
Thank
tough.
you.
That's a tough question. I think the deals just need to work organically for the people putting capital in them today. And with so many other options, like Kitty mentioned earlier, returns increasing in very traditional safe investments like municipal bonds and CDs and things of that nature, the yields need to be worth the risk, because the risks are ever changing with construction costs and the regulatory environment too, which is something we didn't really touch on much. But I think a lot of people have been stung by a lot of the COVID-related legislation at the local level and the state level, dealing with rental rates and ability to reclaim your property in the event folks don't honor their lease agreements.
But let me just quickly, but on the other hand, we've had a lot of legislation passed in the last 2 or 3 months that was designed to make it easier to build. And it seems pretty substantive to me. Do you think that's a cause for some optimism on the ability to build more in California?
It is. When I started in this business, pushing 25 years ago, most cities were trying to push the density down. We were trying to push the density number up, and that's been a complete role reversal, which is a good start. I mean, cities want more density, and oftentimes they want density that is too dense, in my view, where construction costs get too high, and then you're outside of the type 5 wood frame construction, and you're dealing with podiums and things that kill budgets.
Well, actually, the governor created a whole law, and he mandated that we need to create X amount of affordable units in these cities, and some cities aren't on pace. So there was a recent lawsuit in Santa Monica, and a collection of deals got pushed through to get built in Santa Monica, and there's a few other municipalities that are below. The issue with that is those units in Santa Monica still need to go through CEQA, and that doesn't mean that they're going to make it through, but they had to approve a whole lot of things. So there's a lot of other cities like Beverly Hills of the world that are going to need to maybe do some of these same things. So there's a desire to push that direction. You still have to make all the hurdles.
I had somebody ask me yesterday whether builder's remedy will have an impact, and I'm just not enough of a lawyer, which is to say I'm not a lawyer at all, to know whether it will actually survive. But it is at least amusing to see this happen, is that cities they don't have an element, and so because of that, developers can at least try to ask for units, and they can't be turned down at the city level.
Yes, the challenge becomes it's just difficult to build in Los Angeles, the cost and the time. So you take it somebody like Scott, you've got Patrick, you've got James in the room. These guys have an expertise, and it's difficult. Just the time elements, the legislation, and this is what they do for a living. And some of my clients who are not building in California anymore because it's too costly, too time consuming, and too much regulation. They're leaving the state, and we're not backfilling with developers who already have an upper hand because they know how to get things done, even though they may want to build and keep even, but it's just hard to have that expertise to get in here, which is another problem that we have going on in our state, but to keep our rents high.
Okay, a question in the back. Lee?
Hi, thank you. So my question is, do you see yours or your clients' projects are taking more sustainability into an account when they're building, or does it still not pencil out economically? And do you see if the consumers are willing to select a product due to its green features? Thank you.
Anyone?
Yeah, sure. The electrical vehicle charging stations, for example, are a huge competitive advantage that newer communities have. They're not too costly to put in if you're putting them in during new construction. If you're doing a retrofit on an existing community, it's a much harder hill to climb. So that's one example of a feature that a lot of people are responding incredibly positive to, and something we're putting in more than the required codes.
So we have projects that we're working on where borrowers are putting in EV stations, but we haven't yet had any clients who are putting in solar. So we're really trying to bring our clients on board, but putting in solar just kind of affects their bottom line. So they kind of stay away from it. But we do have clients putting in the EV stations.
Bromont, aren't they doing it in Bromont?
Yeah, Bromont, yes. But Bromont is already completed. Yeah. So no, but these are ground up construction projects that we really would love for them to put solar in, but they haven't gotten there yet. But yes, Bromont is definitely putting in solar.
So we have time for 2 more questions. So who are the next 2 that are? Okay, we'll do 3 because this gentleman's been very patient. So 1, 2, 3, and then we're done.
My question is to Tracey and Kitty. So rates have doubled in the past year, but I'm hearing that perhaps cap rates are 4.5. It's obviously negative leverage. I'm just curious how you view that in your underwriting, and if you're taking a listing of a new building that the upside is questionable because the rents reflect the market today, how you're pricing that.
Well, so January, February, I would say was probably the best time for us. December, January, February. That's where our rents, you could see the projections. Interest rates were exceptional. March, April, May, we kind of saw the slide, but we started just pricing as we were and letting our sellers know for good product in well-located areas, the rent growth was going to outpace kind of the change in interest rates. So this kind of got us through maybe June, July. And been working just as we have with all of COVID, because Southern California, or Los Angeles in particular, was very challenging first part of COVID. No one wanted to buy in LA, right? They're like, I'm not buying in LA. So we've been working with 1031 exchange buyers, people who need to have depreciation, family offices. The institutions haven't been in our pocket for a while. So our buyer pool went from 100% of the buyer pool, right? During COVID, we were kind of depending on where we were 40 to 60%. I'd say starting in September, October, we're down to 15% of the buyer pool, 15, 20. We're a much smaller pool of people, because there's a bifurcation, just like Richard had mentioned. It's like the sellers don't need to sell. There's only 8% of the properties that we've got that have debt coming due and payable. Either it's new construction or you got some debt fund deal that might be due and payable, but those people have capital. So whether it's a cash and refinance, or they need to sell, there's no distress of need to have to sell. So as Patrick mentioned, you're just going to end up with kind of fewer trades. But I think those fewer trades end up in softer markets because they're like, well, if I'm not going to see the rent growth that I was going to see in these other pockets, I'm going to come where I'm guaranteed to have some more rent growth, which becomes our neighborhood. So we are definitely somewhere in probably we're at 0 to 10% the first 6 months of the year, February to and it's probably another 15%. So we're probably like 20. You could be 20% off in pricing, but that's if you had to sell. So when we're trading a 120 unit deal right now at a 3.5 cap in LA, but it's a rent control deal that's been rent controlled for 3 years. Our loss to lease on our trade outs are $650 every time someone moves out. It's like, well, I can buy that, and if I look to where my projections are down the road, and we've sold in Southern California most of our pockets, the Irvines of the world, negative leverage. When interest rates were 5, I was selling 4 caps. When interest rates were 6, I was selling 5 caps. So it's not a new phenomenon, but you can't sell a 250 basis point spread in some of those pockets unless there's enough rent growth.
So we have 2 more who have been very patient, and this woman here, please. And then we need to end. And these got to be quick, so sorry about that. So yes, please.
So regarding office, there's a high vacancy in office. And I think there's a probability of conversion to multifamily. But then you have to work with lenders and also with brokers to make it pencil out. And I know some of these office owners, they're also overseas. And a lot of them might have overpaid for this building, so maybe doing a joint venture would be a probability. So what do you see in terms of conversions from office and other retailers to multifamily, and then how to pencil those deals out?
You left out one problem that I see is you could have that lease that was signed 5 or 7 years ago for 10 or 15 years, which holds a stranglehold over that asset and prevents it converting. So the occupancy may be way down, but you have a handful of tenants that control that building for the term of their lease.
There's a group of people who do this. Patrick is one of them. Jameson's doing it. I sold the Blue in Beverly Hills years ago, 10, 15 years ago. And the bonus of doing like the Blue is it was a high, mid-rise, 11-story office building in Beverly Hills. Well, 5 stories is your cap and limit for building brand new construction in Beverly Hills. So if you can get an 11-story, you're the only apartment that's a high rise, right? So that was a special gig. So that was worth the effort and the energy to convert that project because you're getting something a little bit different. Plus the rents made sense, right? But what I'm finding right now, we're getting a tremendous amount of clients calling us saying, look, I've got this problem with this office, let's convert it. The office was expensive to build already. So they're at $300 a foot is the price they want for their office, and you're at $200 a foot to convert. So you have to be at $500 a foot, which is really kind of construction cost of other things, but you might have long corridors, different lighting. So, in a pocket like Van Nuys, very difficult to convert an office complex. But if you're in a pocket that's got very high rents, or you've got product that you can't get because the steel windows, that's hard to build. That's $800 probably.
Yeah.
I mean, is that $800 to build?
And the other thing, the long corridor thing is, if you could figure out a way to have virtual windows where people were convinced they were looking outdoors, even if they weren't, it would be a lot easier to do conversions. But very often, just the layouts of the buildings are not, you would think, oh, this is a no-brainer. They're not using it for office space, but it was built as an office building. And so the configuration of the building is just different than it is for resi. We need to, I want to take the last, because you have been so patient. Thank you very much. And then we are going to wrap this up. So,
is it on?
Yes.
Good morning. My name is Amanda. I'm the Economic Development Manager at the City of San Bernardino. So we've talked a little bit about how municipal fees and regulations can be a challenge to developers. So I'm just wondering if you have any quick, creative, and favorite ways for municipal agencies to be better partners in development during this time.
Great question.
And by the way, Amanda's a star alum of the Ross program. So
Oh,
I call her out for that.
Yeah, and that was a great question, by the way. I'm going to let Scott take that.
Collaboration is probably key. Those fees are high because these cities are growing. There's a lot of infrastructure that needs to be put in place or infrastructure that needs to be maintained. But I believe the answer is collaboration between the public entities and development partners on a job-by-job basis. That's when developments work best, and when a development becomes our job. And I mean that the private investment vehicle, the community, and the public agency. Those are the ones that work best.
So Tracey Burns, Scott Felix, Kitty Wallace, thank you so much for joining us here this morning. Let's give a round of applause.
Thank you.